the bullion banks have been so active for weeks to suppress the rise in gold. But as I've termed it many times, it's an organized retreat. What they were doing is we go up, everybody gets bullish, and they hammer it back down. Then it goes up again and it goes into higher high. Then they hammer it back down. And it's just going to continue. They don't want gold going through the stratosphere. They will let gold go and silver when they choose. They're not going to let the market take it. They have to be in complete control like everybody else these days, it seems. And but gold is in a bull market. We're going to go to new higher highs.
Former money manager David Brady observes deliberate downturns orchestrated by the bullion banks. Yet he maintains the expectation that gold's ascent will persist. The yellow metal has appreciated sharply in recent sessions as easing inflation, soft labor market data, and less hawkish signals from the Fed bolstered speculation that the bank will bring down borrowing costs from a more than two-decade peak in 2024. Brady highlights the recent record high in gold, indicating a bull market. Despite the expected decline, he remains confident in the overall uptrend, stating gold would only be compromised if it falls below $1,824. Toward the end of 2022, gold had been on its back foot, plunging down below the 1,650 level. However, as the calendar flipped, more and more people started running back toward the gold market and have pushed it toward the $2,000 an ounce area in 2023 and above. Meanwhile, Brady dismisses the idea of a short squeeze, foreseeing a long squeeze, while he remains bullish on their long-term prospects. He predicted a potentially higher percentage loss in silver compared to gold, citing its beta of around 1.5. The market surge to $2,000 an ounce in March 2023 indicates strong momentum. While some analysts are extremely bullish, the psychological barrier at $2,000 may pose a challenge. However, there's speculation that surpassing this level could trigger a short squeeze, potentially paving the way for significantly higher prices by 2025 and beyond, potentially reaching substantial highs by 2030. Now, we present the clips of David Brady's insights from his recent interview with Palisades Gold Radio. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Well, first of all, the obvious answer is we've broken out to a new record high. So we're in a bull market. What people struggle with is they expect, we hit 2152. That is just going to keep going up higher. Markets work in zigzags. Now, when you're in a bull market, those zigzags trend overall up, higher lows, higher highs. And by contrast, when you're in a bear market, it does the exact opposite, lower highs and lower lows. Well, obviously, we have higher highs and higher lows, so we're in a bull market. But at 2152, when the banks are significantly short, sentiment is not bullish, it's euphoric. Technicals are extreme overbought. That's a time to take a pause and say, hey, we need a correction here. And that's what I said on December 13. I called it the perfect storm. And that's what we're going through right now. We're going through a correction. I believe that we've had what I call the ABC correction, and we've had the wave A down to 1988 in gold. Now we're in wave B. Now it may have peaked. I doubt it, but we may have peaked, but I have no confirmation that it has. But once we get the peak in B, then we'll have a good idea of where C is. And I just wrote an article today for Spot Money where I said, here's some suggestions if we peak at 2063, if we peak at 2100 in wave B, this is what I think wave C will turn out to be. But one thing I have confidence in is that the next low will be lower than 1988. So I don't know exactly what that number is. Mm-hmm. It could be 1933, it could be 1900, it could be in the 1800s. But we're going down to a lower low, in my opinion. Now, at that point, and I don't want to belabor it because I've talked about this, to death. At that point, at that low, you'll know most retail traders will throw in the towel. They'll be just fed up. A minute ago, we were at 2152, and now here we are at 1900. What's the point? The same old same. I'll be loading up for what happens next. Because this is an ABC correction. The zigzag's down, but it has to fall below 1824 to negate the uptrend. It hasn't, and it won't, in my opinion. So when we get down to those low levels, it's a gift. And I plan to go all in on those. I'll be using high beta miners. I'll be going full leveraged because what I believe is we're going to go up to another peak that exceeds 2152. It may even just be 2200, but from 1900 to 2200, especially if you're leveraged, you're going to do pretty well. So to answer your question, we're in the correction. We're waiting for the bottom, waiting for the wave B top, then the wave C bottom, and then up we go. I saw somebody say on Twitter, oh, there's a short squeeze coming. Yeah, there's a squeeze coming, but it's not going to be the short squeeze. It's going to be a long squeeze. And that'll generate the lower low that I just mentioned in gold and in silver. The percentage loss in silver will be greater than in gold, as it always is. It has a beta of about 1.5 to gold. So to answer your question, yeah, I think it's going lower. And the bullion banks have been so active for weeks to suppress the rise in gold. But as I've termed it many times, it's an organized retreat. And how do I validate that? We keep hitting higher highs. So what we're doing is we go up, everybody gets bullish, and they hammer it back down. Then it goes up again, and it goes into a higher high. Then they hammer it back down.
David Brady analyzes mining stocks while emphasizing the importance of beta over the past 15 months. He examined 160 miners and found MYUX and IAG to be high performers, particularly during a 40% silver surge. The four analysts offering 12-month price forecasts for McEwen Mining Incorporation have a median target of 12.38, with a high estimate of 18.50 and a low estimate of 11. I am Gold Corporate, which has surpassed the FTSE 100 in the last 12 months, demonstrating a 23% increase in its stock value. Currently, momentum is a highly valuable asset for UK stocks. IAG trades at 4.5 times TTM, trailing 12 months, earnings, and 4.3 times forward earnings. That puts it at a 78% discount versus the industrial average. Furthermore, he emphasizes the correlation between GDX and silver, using silver as a benchmark due to its higher volatility compared to gold. The correlation between SLV and GDX is 0.72, which is considered to be high. That indicates a strong positive relationship between their price movements. Let's get back to the interview.
In my articles that I provide to Sprott Money and now my Substack, I lay out in detail how I come up with it. I don't just say, hey, gold's going to go down to 1950, 1900, and then I'm going all in for 2200, maybe 2300 next. See ya. No, I give all the detail, and it's data. It's not opinion. Here's why. I got criticized by a very well-known person. You always caveat, in my humble opinion. We already know that. Yeah, but I like to say it because it's true. And secondly, I don't want somebody coming back, you told me this. But it is opinion, but it's based on data. A process that was developed looking back 20 years at all the peaks and troughs, looking at consistent patterns across those peaks and troughs for every asset you can think of on the futures market, and using 6 multiple tools. It's not rocket science. Anybody can do what I'm doing. They just don't put the time in. I look at beta only 15 months back. And because I like a recency bias because I know what's going on, what's driving it. So I went and I looked at, I think it was 160 miners, and I calculated their betas going from trough to peak to trough over the past 15 months. And I found 2 in particular that are starting to become fallen angels, by the way. They're having a little trouble right now. That stood head and shoulders above the rest. And that was MUX, McEwen, an IAG, I am gold. And I made, what was it, 200% on those when silver went up 40%. I use silver as my benchmark because surprisingly, GDX and silver are highly correlated. And silver is more volatile than gold. So it was a better benchmark in terms of performance because silver underperforms gold on the downside and outperforms on the upside. So if you've got a high beta to silver, never mind gold, a high beta to silver, this must be a great stock. So I did extremely well with that. So then I delved a little deeper and I found like I have 11 in my portfolio right now that I follow. And what I do is I follow the winners and I scale back when the others start to come off. But they consistently high beta. Both, it's a double-edged sword, I call it. So it goes up, yeah, but when silver goes down, these things get hammered. So you have to get out. When you get to the top, don't get greedy. I call the top in MUX at 10. And I said, get the hell out of this. And that's what happened. Mm-hmm. It was a nice round number. The technicals and all the other things were saying that it was overbought. But when I saw 10, there's a number that the market likes to stop it at. Just like 666 back in 2008. And it went down. But the point being is, you can isolate these miners. And people will say, well, you're not focusing on the fundamentals. No, I'm not, because the market knows better than me. The market knows which ones are going up and down. And if these are consistently driving high betas in both directions, the market knows, somebody knows that these are the ones that they've chosen these stocks to play when silver goes up and gold, obviously, and then when it goes down. And I'm just following what the market's telling me. And then when the market tells me, no, this is not doing as well, it's not it's not correlating as well as it was in the past, it's falling back into line with silver, or it's underperforming more so on the downside than it's exceeding on the upside, then I start to scale back on that one, and then I put more capital to the one that's doing better.
Gold could form a bull flag pattern, sending prices soaring much higher. For example, the author of Rich Dad, Poor Dad, Richard Kiyosaki, has a gold price forecast of $5,000 in the next few years. What do you think about the future trajectory of gold and silver prices? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.